in from some of the politicians who are part of these seven delegations that are headed all across the world to reiterate India's stance against anti-terrorism. But let's get in conversation with Digant Tharia, co-founder at Green Edge Wealth, who is joining us on the show. Digant, morning, and appreciate you joining us today. Give us a sense of what you are expecting the market to be like today. Which sectors are expected to tip once again back into the green, given that we've ended across in the red across all sectors yesterday? Sharp cuts coming in across realty, FMCG, IT, auto, some heavyweights and defensives that were under pressure. Do you see them edging towards the green today, given that they have consolidated significantly yesterday?
I don't think I have a day-to-day view on all of these things, but see, the overall setup is such that, see, yeah, like yesterday's correction happened probably because of the Japanese debt. The world suddenly woke up to the Japanese debt problem. I think, see, Japan and US are two economies which are laden with debt, and they will keep on they'll keep on pestering the world markets time and again till at least September. So you will get these bouts of volatility, but I think the overall setup for India is pretty clear that India and maybe a lot of other emerging markets, that crude oil is down, commodities are down, US dollar is no more strong, the DXY is weakening. So I think this is a setup where we should do well. The numbers have not been too bad. So I think we'll again see a market where there'll be rotation, like the financials could make a comeback. The financial sector in India could make a comeback. The industrial and the PSU sector, which has been down and out for the last 6 months, that could make some comeback. So I think the setup overall is decent. Something where we don't make lifetime highs, but we don't fall either. And I think that sector rotation should happen.
All right, so sector rotation expected to happen. But Digant, the point you just highlighted, I wanted to get a more sense on this one because for Japan, long-term bond auctions, that has actually got the weakest demand since 2012. Do you believe that the next signal for the markets will come from the bond markets, and how crucial it is to watch for the bond movement, especially for the Japanese bond auctions and the prices that we go ahead? Because for now, Japan has been one of those spots which actually offered the lowest interest, or rather the kind of the lowest, the safest of the havens for investors. So do you believe that it could have some implications on the FII number for emerging market as well?
Hi. So see, I think that US and Japan, these are the two economies which have a lot of debt which comes for refinancing. And see, the world has had enough of these two economies binging on debt. So see, Trump is already trying to do its bit by de-addicting the American economy from debt. But see, they still have to do all the refinancing. So similarly for Japan, and then, if you look at US, the rates have increased from say 1% to almost 5% in the last 2 years. Japan was, probably around 0%. Now we are getting close to 3. So I think Japan is also adjusting to those realities of, a debt-laden economy. I think we'll see some more shocks, from US bond markets as well as from Japan over the next 6 months. But I think the world is ready to move on, because we've already seen 1 or 2 shocks in the last 6 months. Countries like China, a lot of them are banking on gold. So, we saw a very good rally in gold. So I think this is a move away from that old world order of, US dollar and Japanese yen, dominating everything. But see, they have been the very strong currencies and the bellwether of world market. So whenever there's something wrong which happens there, we'll correct for a day or two. But, but I don't see that, we go back to those March lows or anything, because we are doing well. A lot of other emerging markets are doing well, and they're probably just saying, hey, you guys manage your problems. Yeah, these are not our problems. So at least that is what we think.
Right. Okay, let me just welcome on board Rajesh Palve as well and get in his thoughts on the markets. Rajesh, hi, morning. Which way do you think we're going to head after that 200-point index decline and, of course, weak market breadth as well yesterday?
Good morning. Looking at the correction on the previous day, again, Nifty is now back near to the important and major put-based concentration of 24,600. So these level needs to watch closely for near-term perspective. If at all Nifty manages to hold about 24,600 level, I think some support buying action should emerge again around these level, and some pullback towards 24,750, 24,800 would be there. But again, on the higher side, 24,800 needs to cross to continue again, this upward trajectory of the market. But overall, for short to medium term perspective, trend is still on the bullish side. This correction should be used as a buying opportunity in the market, as the structure is bullish. Index are trading about to all its near term, short term moving averages. So I think one should deploy their investment in this decline. 24,600, 24,500 are likely to act as a good support area, and again I think after a brief consolidation we may again resume to the upward trajectory. About 24,800 short covering action would be there. On the bank nifty, yes, there was some underperformance because some heavyweight private sector bank have corrected in the last couple of days, and that has created some pressure on the bank nifty, and bank nifty is now trading below to 55,000 level. So for bank nifty, 55,000, 55,200 are the important resistance area. Until the bank nifty not crosses above 55,200 level, I think some consolidation in range of 54,500 to 55,200 would be there. But looking at the medium term to long term perspective, I think again after a brief consolidation here also we may attract the buying action, and possible breakout above 55,200 would be there. One needs to be very selective in terms of stock selection at this juncture, because profit taking is happening in the market. So I think very select pockets are showing strength. So one needs to be stock specific for some couple of days. Once breakout happens on the index, I think yes, broader market will also start performing on the higher side.
Rajesh, thanks for that view coming in. Those are the levels that Rajesh is spotting for Nifty as well as Nifty Bank today. But once again, let's shift focus to earnings and let's talk about FMCG player Colgate. That's going to be coming out with its quarter 4 numbers today, later in the day today. And it's a muted set that the street is largely penciling in to see for quarter 4 for Colgate. When you take a look at what could the earnings fine print look like, revenue is expected to come in at 1,522 crores, which is an uptick of only 2.8% on a year-on-year basis. But this is the only metric where we are seeing even a little bit of an uptick, because EBITDA, PAT and margins is something that we're expecting to decline. EBITDA is expected at 500 crores, which is down 6% year-on-year. Net profit also expected to take a cut of 5% on a year-on-year basis at 361 crore rupees. Margins are expected to be under some pressure at 32.8% compared to 35.9% this time last year. Overall, the oral care revenue is expected to grow by just 4% on a year-on-year basis. Toothpaste volume growth is, we're expecting this number to come in at 3%. Remember, last quarter, this number was anywhere between 6 and 7%, which means we're expecting this volume growth to half just on a sequential basis. So looks like this could be a weak set of numbers from Colgate. Higher ad spends and operating activities are also expected to weigh on margins. Now, when the numbers do come out later today, what's going to be important to note down is promotions in general trade, the quantum of discounting that the company has given in alternate channels, demand outlook, especially in urban, since we have heard across the FMCG index and all players saying that rural demand is maintained where it is, but urban continues to be subdued. And if the company has taken any price hikes, that's going to be important to watch out for when the numbers come out later today. But well, yes, that's what we're expecting from Colgate. Weak set of numbers, or a muted quarter is what we're expecting this time. But Aditya, let's come to you and talk about what your expectation is when it comes to a lot of these FMCG names, because we are inching towards the end of the earnings season. FMCG across the board has seen an uptick in revenue, but a decline in margins. You name any company and this has been the case. What's your take on the Nifty FMCG index now? Do you believe that a recovery is something that you're penciling in on the charts? Aditya, I hope I'm audible to you. My question to you was on the Nifty FMCG index. Fundamentally, the stocks have taken a hit for quite some time now, but there is a recovery that we are seeing. Is that being reflected on the charts as well?
Absolutely. I think FMCG was one of the first sector which showed recovery when markets were very volatile. And I think recently the correction, like the correction which we saw yesterday, has spoiled the chart pattern in the short term. But if we take a view of, let's say, few months, then I think FMCG stocks post a great chart structure. A lot of components are starting a fresh leg of rally, and that's happening after a long period of consolidation, which means there's proper base building activity, proper accumulation happening in these counters, and then a fresh leg of rally starting. So I think in 1 or 2 weeks there could be some correction, but that should be taken as buying opportunity. If you talk of the index level, then Nifty FMCG basket is trading at 56,200. Accumulation zone for this would be 54,000, 55,000. And I think that in near term future, this index, as it's making higher low, higher top patterns, in the near future, it could touch 60,000 to 62,000 mark also. So on a medium term time frame, I maintain bullish stance on FMCG basket.
Bias on the FMCG index, that's the view coming in the charts. But Digant, pretty much at the fag end of the earnings season, what's been your analysis and read through from earnings so far? And where is it that you have your sector overweights and underweights?
So, see, I think the earnings were quite robust, versus the expectations. Because Aisha, if you remember, from October to March, we had a continuous round of correction, and the talk then was that capex is slowing down, consumer there is absolutely no revival. So I think the earnings expectation were quite muted. And versus that earnings expectation, I think we have done quite well. Especially when it comes to sectors like industrials and PSU and capex and even some pockets of the consumer sector. Not the large FMCG ones, but something like a Whirlpool. A lot of them give decent set of numbers. The cement stocks. So I think there is not much to complain on the numbers. Again, it's a very standard response that we have to be stock specific and choose our battles, because it's not going to be an all-out bull market, but it will be a reasonably stock-specific, sector-specific bull market. And see, something like financials, the results were absolutely, lackluster, but that was expected. Q4 was going to be a reasonably bad quarter for all the large banks, the mid-sized banks, even a lot of these microfinance and high lending NBFCs, something like a Bajaj Finance. Everything was lackluster, but that was expected. I think June should be, one more quarter of lackluster performance, but after that, you will see in 3, 4, 5 quarters of really improving performance from the financials. So maybe the results were not good, but probably this is the quarter where you start building positions in beaten down financials or beaten down consumer names, because that is where it looks like we'll have the next bull market coming. So our read through is that in industrials and capex space, if your stocks are delivering good numbers, you continue there. But otherwise, you can start building positions in the beaten down financials and beaten down consumer names, because the result, those early signs are there that results will improve in the coming 3, 4 quarters.
So beaten down financials, let's watch out for that. But Digant, one segment that has been doing very well, that is the EMS space, because across the board, the companies have come out with very strong set. Look at the numbers for Dixon Technologies. It's a triple-digit growth number is what the company has reported, and going ahead, the management is confident of margin improvements, especially in the mobile segment. Give us some sense, how are you looking at this particular space? Any particular take on Dixon Technologies, if you can share with us? And also on the valuations, Digant, the stock is trading anywhere between 70 to 80 times. Do you believe that it still holds, it can still do well in such a market?
So yeah, you're right that this whole EMS space, it has been the biggest manufacturing success story of India. Right? We've been talking about Make in India from 2019, but yeah, this is one space which is right in our face, which keeps on growing on a higher base year after year, quarter after quarter. So there is very little doubt that they'll not do well even for the next 2, 3 years. So be it Dixon Tech or be it Keynes or be it PG Electroplast, I think these companies have a long future, because the government is giving them incentives in terms of PLI. And see, what they are essentially doing is import substitution, right? India is a very large electronics market, and in fact, electronic products are the third largest import, third largest thing that we import, after oil and gold. So this space will continue to do well. But see, questions on valuations will always, bother everyone because they trade at 80, 90, 100 times. See, nothing in India, which grows well is available for cheap. So, we have to make room for it in our portfolio. If we have some room in the portfolio where we can chase these high growth stocks, I think some of these definitely make a cut. Because we are not very, very comfortable with very high valuations, we try to find, some proxies, something like a Ram Ratna wires, which will make those AC tubes. So, if Dixon and PG, they grow well in the AC segment, their ancillaries also do well. Something like a Whirlpool, which has started doing well. So there are a lot of ways to play this sector. Maybe Dixon is not, not in our comfort zone, but surely the company is doing great and will do well. So
Okay, so that's Digant's take on the valuations in the EMS space and how he would like to play that space. Rajesh, I'll come to you. I want your view on railways. We have a stock in focus today, Aircon International. They've received a work order of 253 crores from Southwestern Railways. But other than this, Rajesh, if you take a look at how some of these railway stocks have done in trade yesterday, sharp cuts across the board, anywhere between 5 and 8% for the likes of Aircon, IRFC, Railtel, IRCTC, all of these stocks were down and out. Rajesh, help us understand if we are at the end of this railway rally that we've been seeing over the last couple of weeks. Do you believe that this space has been overbought and now time for some correction that's here to stay?
So we have seen a very sharp run up in most of the railway stock, especially in last week. And looking at the profit taking at higher level is a normal course of correction in these stocks. As most of the stocks has shown recovery from their long corrective move. And looking at the near term, short term structure, there is a breakout on the near term as well as on the short term chart. Still, most of the stocks are trading about to their near-term, short-term moving averages. So I think still there is a room for another round of rally in most of the stocks, despite the run-up which we have already witnessed in the last week. I think in the correction, Ircon, if it's gives you opportunity around 180, 175 zone, it's again good level to re-enter in this counter as breakout level is intact despite of this correction. So around 180, 175, one should try to buy this stock. Again, on the higher side, once stock crosses above 195, I think rally can extend to 220, 230 kind of zone. There is correction in Titagarh wagon also, but again, looking at the near-term chart, stock is holding above 100-day moving average. So I think Titagarh is also, if you get opportunity to buy this stock around 850, 860 zone, would be again attractive level to buy in this correction. Keep your stop loss around 840. On the higher side, once stock again manages to cross over 920, here also we may see another round of rally to continue. So most of the stocks are still holding the ground at above the breakout level. So I think buy on dip should be strategy at this juncture. There is no sign of cautious at this juncture, as structure is bullish for near term to short term perspective.
In on select railway counters, but Digant, within the PSU basket, any stock that you like, or rather any sector that you like at this point in time, because off late they haven't participated much in the rally that we have seen for the past 2 months, barring select PSU financials, and off late select counters like Coal India, ONGC, they are inching up higher. So do you find value in any of these pockets?
yeah, so I think the mining space is something which is of particular interest to us because see, the world is rebuilding itself. If you look at Europe, Germany, US, everybody is talking of reindustrialization, maybe increasing the spending on defense and factories. So this whole aluminium, copper, or even iron and steel, these are three metals where we think that anybody who can mine these metals or their raw materials, that should do well. So in India, mining sector is largely controlled by the PSUs. So something like a MOIL or an NMDC or even something like an Oil India or an ONGC who drill out oil. See, oil prices are also at its low, and I think over next 1 year we can expect those oil prices to recover. Once these tariff tensions are away. So I think any of these stocks or a basket of them should do quite well. So amongst PSUs, mining is our top pick. Obviously, defense has rallied a lot. Otherwise defense would also have been a good pick. But yeah, just like Dixon, defense stocks are also out of the valuation comfort zone. And then, if you look at, the other PSU financials, especially something like a PFC, REC, Canara Bank, PSU. I think in that pack, Bank of Baroda, Canara Bank, these PSU banks, they are trading at good value. Maybe Bob is at, Bank of Baroda is at 0.8 times on FY27. There's easy 20-25% upside, but that will need some bit of patience because, as I said, the next 1 or 2 quarters for the large banks and financials, they may not be great, but after that you will see 3 to 4 quarters of good recovery. So I think mining is our number one preference, and maybe the beaten down PSU financials, especially something like a Canara or a Bank of Baroda. I think those stocks are where we find value and improvement after say 1 or 2 quarters.
Thing, right? I mean, there's one hand, of course, growth visibility. The other thing is always about the price that you actually pay for that growth. But Digant, other than PSUs, where is it that you have any valuation comfort right now? Any sectors or pockets?
Yeah, so I think in this NBA, not NBFC, but let's say small finance banks, the ones which are lending at a high yield, something like an Equitas or an Ujjivan, or even new listings like Northern Arc. See, these companies have suffered because the interest rates were very high. The microfinance sector was going through pain, and the regulator was also behind their back in terms of tightening the regulations. Now, if you look at next 12 months, all these three factors will come in their favor. What was against them will actually come in their favor. So, these entire high yield lending pack in private financials, that can really do well. So, that fits our theme of beaten down financial stocks. Then, even beaten down consumer names, something like, say, a Whirlpool, or a Heritage in the dairy space, or a Flair writing product. So there are, this entire consumer space is a very big space. So I think beaten down consumer stocks which have done nothing for 3-4 years, I think that is where we are focusing on, and we are finding enough ideas. It's just that we're waiting for some growth. Something even like a Kajaria or a Sera, or a Sheila Foam. All these consumer names, they've done nothing for 3-4 years. So any recovery which comes after the monsoon, and I think these stocks should reward their investors.
Okay, Digant, thanks for that view coming in and appreciate you joining us today. On that note, we'll let you go.